Hi everyone, in this video we're going to be taking a look at the exercises here for chapters 9 and 10, the current and long-term liabilities chapters. And first tab, as usual, has a lot of just matching terms, etc. So I'll let you all do that on your own. And then let's move on to tab number 2. Okay, I'm going to open up an Excel spreadsheet here on my second screen. I might need to do some calculations here, but we'll take a look. Okay, so in this problem, it looks like we're doing what do we have? Unearned revenue type of transaction on the 16th. We received money in advance of a tour here, so Evil LV. So it's like a concert tour thing. And so if you're selling the tickets in advance, you need to get the cash immediately, but you aren't going to record any revenue earned. Maybe I meant to do unearned revenue. You're not going to be able to count that cash received as revenue until you actually, earn the money. And so it's a 3-date tour. So if we have 48,000, divide that by 3, be 16,000 per performance, right? So then we're going to reduce our unearned revenue by debiting that liability to reduce it. And then we're going to record our, where was that, event revenue, I think was the account there. Yep. And here we can, I'll just put the formula in so you can see how I got that. So 48,000 divided by 3 gives us 16,000. And so 3 tour dates. So every time that we complete the performance, then we're able to earn 1/3 of the total that was paid in advance, essentially, right? Okay, and then we've got some transactions here for selling merchandise, basically at the concert kind of thing. And so in this instance, we're going to be receiving cash. And it was, we'll figure out how much cash we're going to get. And then we're going to have some revenue, so sales revenue, just sales, and that. And then let's go through and put all our accounts in here first. We have cost of goods sold. We have merchandise inventory going down. And finally, we're going to have sales tax payable that we record as well, because we're going to collect some of the proceeds from the tax from the sale from the customer, right? So as far as the revenue goes, we earned 16,000 selling the shirts, basically. Oh yeah, okay, we get it. That's kind of funny. We're not done yet. It cost us 8,000. So our cost of goods sold was 8,000, and merchandise inventory will go down by the same amount. The sales tax payable is going to be 9% of the sale amount, so 16,000 times 9%. And then the amount of cash that we're going to receive then would be the 16,000 plus the 1,440, because they're giving us money, for selling the stuff, but then we're also collecting an extra amount for the sales tax that we are collecting from the customer, essentially, right? And then later, when we remit sales tax, we're going to reduce our sales tax liability, and we're going to pay cash. And we can just link up to that cell again. It's just that amount. And yeah, that's all the transactions there. So again, unearned revenue, kind of for the first part. And then as you're doing the thing that earns the revenue, you're going to earn that revenue in some proportionate amount. This was a 3-date tour. We did the first one of 3. So that's why we divided by 3. And then if it was a 2-date tour, right, we would have just divided by 2. 4 dates, we would have, every performance. So every performance just earns whatever that proportion is. And then down here, we just did a normal sale of inventory transaction, but we included the component of 9% sales tax payable on the sales revenue. So that's an extra little piece that we had there. And then this is just us getting rid of our payable and the liability by remitting the cash in that instance. Okay, let's look at the next tab here. So in this one, we've got your company's employees earn $42,000 for work performed for a 2-week period. They'll be paid on June 5th. We have income taxes, Social Security, Medicare, and medical insurance. And then we have FUTA and SUTA tax as well. And we need to record the employee earnings and then accrue our taxes as well. So the first thing I like to do when I'm doing these types of problems is just go in and do your expense part first. Put in the 42,000. This is the expense to the company, right? We've recognized 42,000 in expense related to our employees, and then we're going to have to withhold amounts from their paychecks. So we're not going to pay them 42,000. We're going to keep part of that, but then we have to send the part that we keep off to the government, the medical insurance, the insurance company, so on and so forth. Okay, so let's just go line by line here. Federal income tax, we can do that first. Federal tax payable. Then we have state tax payable. Then we have so federal income tax, state income tax. We have Social Security. And let's find that here. Social Security payable, Medicare payable. Then we have medical insurance. So this medical insurance payable. And finally, we have salaries payable. So that's just the residual portion then, basically. So we have 8,400 withheld. It just tells us 4,200 for state taxes, 2604 for Social Security, 609 for Medicare, 1260 for the insurance that was withheld, and then the residual portion, then we just take our total expense minus all the withholdings. You got to kind of use your up and down arrow to be able to access that little last tab there, or last cell. But that comes out to 24,927 that is actually going to be paid to the employees. And then I'm just going to skip down to this one since we just did this. And we're going to, later when we pay the employees on June 5th, our cash will go down and that payable will go away. Just like, when you pay an accounts payable or something, it's all payables, all liabilities, right? Remember that they decrease with a debit. So now the payable's gone. We've paid our employees and that portion of the whole transaction is done. Eventually we'll have to pay these amounts too. It doesn't have that, shown here necessarily, but we will have to remit these amounts as well to the government and to the medical insurance company, so on and so forth. Okay, so not only do we have to, pay our employees and withhold their taxes and pay it correctly, we also have to pay our own taxes. And so we are going to say payroll tax expense. And so something you kind of just have to remember is that FICA taxes, or that's the term to refer to Social Security and Medicare. So we can have, the business also has to pay those taxes as well. And they pay the same amounts for those that the employee did. It's kind of half and half, basically, if you want to think of it that way. Half paid by the employee, half paid by the business. What else did it say? Anything else there? So FUTA and SUTA, the unemployment taxes, are just paid by the employer. So those are not paid by the employee. So that portion of it, as you kind of could see if you looked back, we didn't put any FUTA or SUTA stuff there. So we just put that in for the employer side. And then for our total payroll tax expense, now we just need to add all this up. And the total of those cells that we're going to have to pay ourselves, pay out to ourselves. And these amounts that we're paying, if you want to call it that, is we're really just remitting the employee's money. We just it's our job as the employer to just hold that back from their paycheck, keep it ourselves, and then send it out. This portion is us and what we actually have to pay ourselves, right? This is our more expense that we're recognizing. Okay, so there's all those ones. Let's move on to the next tab. I don't know why these rows are a little squashed, but let's fix that. Okay. All right, so now we've got a warranty liability problem here. So during whatever 2021, your company had 400,000 sales, offers a warranty. We're saying it's going to be 4% of the sales. So 4% of 400,000, it's probably 16,000, I think. I go here, let's just we can do the math in the cell, that's right. So we can just say equals 400,000 times 0.04. Did my guessing math right? And then we're going to record warranty expense, and then warranty liability will be the other somewhere. There it is, estimated warranty liability. And then this is real, expenses that we're paying now for under warranty. So on April 1st, we have to pay 4,000. So what we debit is not expense at this point, but we debit the estimated liability to reduce it. Hopefully, when we captured that 16,000, that is gonna, be enough to capture all the amounts that we actually will have to pay out. That may not be the case. This is just an estimate. It might be more, it might be less. So a warranty liability is something that would have to be continuously monitored, essentially. These journal entries are all going to be the same, so I'm just going to paste all these in. And then let's go and see, what was it, 3,800. 4,200. Yeah. There we go. Sometimes it tries to tell you something's off before you're done putting stuff in. Okay, so the sales in this period, and we estimate it's going to be the same thing again. So really, basically, this is going to be the same journal entry. I'm just going to paste this in here. And I'm just out of curiosity. So our total, I'm going to highlight all these cells and it'll add them up. So we actually incurred 15,600. So our estimated warranty liability at this point would have a credit balance of $400. And what did we have now? 440,000 times 4 sales. So we just put more, so we're a little bit over on the warranty liability. But as long as those products are still under warranty, from the first year here, it's kind of different from the allowance for doubtful accounts because the warranty could still be recognized. These are just the ones that we know about, to this point, essentially. But all right, that's the warranty problems. Got to have a financial statement in here. So we've got a whole financial statement problem, and we're going to start with our income statement. So looks like, are we doing service revenue? I didn't even look. Okay, yeah, service revenue 1,540. What's our expenses here? So we've got different expenses related to, maybe I'll start in alphabetical order. Let me just go through here and say, okay, amortization expense would be a first one. Bad debts expense would be in there. Depreciation expense. Interest, remember, actually, we're not doing a multi-step income statement. So everything's just going to be revenues and expenses. So it's not like how we had in the test recently with a breakout of other gains and losses. We're just doing more of a simple income statement style in this one. Wage expense and warranty expense, I think, is the last two. Okay, now we got to find what those amounts are. So 28, 21, 35, I think. Got to eyeball it here. 42, 630, and then warranty expense is 49. We can just do a formula to sum up all of our expenses there. And then we can take our revenue minus expenses. Oh, geez. Sometimes it's hard to, the formula cell thing comes up and covers up the cell that you want like this. And so you have to click into the formula and then use your arrow keys to navigate to the right cell you want. So just a little Excel FYI for you. And then we're going to say this is net income somewhere, hopefully. There we go. Okay, now we're going to start with we're going to do our retained earnings statement here. So we want beginning retained earnings, and that tells us it's 105 plus net income from above. There we go. Minus dividends, I think I saw up there. Yeah, dividends of $70. And then that gives us ending retained earnings. So that's going to be that plus there minus the dividends gets 770. Cool. Okay, so we are doing we didn't do a big broken out income statement, but we do have a classified balance sheet with current assets and non-current stuff, current and non-current. And so let's go ahead and put all of our accounts in here. We'll start with cash, accounts receivable. Do we have any prepaids? Yeah, there's prepaids. Maybe it wants prepaids down below. Sometimes yep. We have inventory, maybe. No. What else do we have? Service revenue. So we are a service business, not a merchandiser. Allowance for doubtful accounts, right? Can't forget that. Our contra asset, remember, so a little bit unique there. It's a subtractive item. So we'll have to see if we need to put a negative on it, because that's what it's going to do. Yeah, so put a negative in there. It's going to reduce that 105 to give us net AR. So let's add all these. Actually, I'll just do equals the sum. 301. Okay, awesome. And then under plant assets, I think we're going to have machinery. We need accumulated depreciation for that machinery. And then we have land. And remember, the land never depreciates. Land is just land, and it stays the value it is on your balance sheet for the entire, it doesn't depreciate at all, basically. Okay, 175, and then land was 700. I'm going to copy this formula because I think that'll work. And then, yeah, we just kind of, fix it there. Okay, long-term investment. I think I saw bond payable. Oh, that's a payable. We need investment. Oh, note receivable. Okay, so we have a note receivable. So we loaned out some money, and it's 4 years later, so it's going to be in the long-term section. Sometimes you have a breakout between current portion and non-current portion on things like that. And you see that with debt as well. As far as intangible assets go, okay, we have goodwill. What else do we have as intangible? Oh, a patent. Okay. Sometimes I have to think if they, usually it's not. I find these problems designed well because usually it doesn't yell at you too much in these input spots if you put them in the wrong order, or if it's supposed to be alphabetical order or something like that, which some of the other textbooks and products like this I've used do get upset if it's not, if you don't put the accounts in the exact right order, which may be the case. Maybe we're just nailing it. Definitely, as far as current assets go, you should be really familiar with cash is going to go, that it's in descending order of liquidity, so most liquid to least. And then accounts payable is always our first payable line because it's the most going to be paid the soonest, essentially. Okay, what else do we have in our current liabilities section here? Look for payables. That's kind of the one big thing we want to see. Bond discount, that's going to be more long-term, I think. I'll put that one here. See, it's due on the 8th year. We're in the 1st year. And then we're going to have a bond payable discount. So bond payable 700. The discount amount was 21. Oh, it needs to be negative, sorry. That's kind of like the contra asset up there. Take that formula. Okay, so we're getting pretty far along. So I think now we just need to find our other liabilities, current liabilities. I think estimated warranty liability is going to be in there. And then, what are we? I'm going to like stare at this thing. So I think we got all those. Well, we'll put this in. There's one more that we're missing. We have AP. Sometimes I gotta really strain my brain here to look at these two. Okay, what am I missing? I am missing something, but I'm not seeing it. Okay, let me get all the rest of this in. Maybe when we see the difference, sometimes that helps to tease out the thing that's not there. So common stock then is, what was common stock? 581, and then retained earnings was off our retained earnings statement, 770. So that gives us a total amount there. And this is total liabilities once we get everything in. Oh, we don't want assets, sorry, I went too far. So just those two. This will be equity plus liabilities. And then this will be a summation of those 3 lines. What are we missing here? We got the discount, we got the cash, we got the payable interest expense go to land. Is the note? No, I was thinking maybe there's a note receivable portion of some small component or something would be a current portion. Sometimes that's, like I said, maybe we're missing some info. Let me go back up here and see. Are we missing anything? Doesn't look like it. I think that's capturing all the details. A lot of times you'll see like wages payable in a problem, but we have wage expense but no payable. We've got our accounts payable. Sorry guys, I'm not seeing the additional current liability that we want to have included. Prepaid advertising service. Oh, I'm sorry, unearned revenue. There it is. Burp. I'm a dork. Okay. That was hiding from me. I feel your pain. I know you guys have done something like that on an exam before when you're trying to complete these problems and the last piece is eluding you. Maybe you're seeing me do that on screen and yelling at me through the computer. So thanks for bearing with me there. And so we got everything in again. Current liabilities, estimated warranty liabilities, a new one. We've seen bonds payable before, but now we're seeing discount. We kind of know how to work with that a little bit from our problems in class. We got some intangibles. Note receivable is a long-term investment. Plant assets, don't forget your accumulated stuff, your contra assets, accumulated depreciation, and allowance for doubtful accounts. Okay. So that's great. I got all our X's to go away, and let's move on to the next problem here. Okay, we're on to tab number 6 now. And in this problem, we're going to look at a bond kind of a bond accounting amortization type of problem. And so it says we issued, was that $40,000 of 5-year 8% bonds at 97, so 97% of that total value. Or in other words, the discount will be 3% of 40,000, which is probably, what is that, 1,200? Yeah, it must be 1,200. Yeah. Okay. And so here we've got bonds payable that we're issuing the bonds, right? So we want to have a payable for those, and we're getting some cash, right? This is the whole point of issuing bonds, is to raise cash. And then we can, you got to kind of think about the logistics here. So the bonds payable are $40,000, but we're issuing them with a discount because it's only at 97% of the full value. So if we take 40,000 times 0.97, and then the difference between those two is the cash discount, the 1,200. Well, I thought that would go away. The X is there, but maybe when we put this in, and then we're going to call that discount on bond payable. Yeah, there we go. And so we didn't get as much cash as we would like because, from issuing this debt instrument, this bond payable, we were only able to borrow 97% of the total amount that we're going to have to pay back, because the current macroeconomic environment, essentially, investors who might otherwise buy our bonds could get better deals elsewhere, and so that's why we're issuing these at a discount, because 8% isn't as good of a return as bond investors could get from other issuers, essentially. Okay, so now we're just going to do our interest and our amortization of our discount. So we have interest expense. We have cash that's going to be paid out. This is for just the amount, the amount of interest there. So just all you got to do for the interest piece is take, and that goes, or sorry, the cash portion of the interest will be 40,000 times, all right, oops, that's there, times 0.08 divided by 2. And I'm dividing by 2 because we're saying we have 2 payments per year. So it's 8%, but it's paid twice. So we need, it's really 4% is what it comes out to, but twice a year. So it adds up to 8%. Okay. And then what we need to figure out when so for amortizing our discount, we need to figure out how many payments there are going to be over the life of this bond. And so it's 2 times a year, and it's 5 years. So 2 times 5, there's going to be 10 payments. So we want to take this amount of the discount divided by 10, basically. So it should be 120. And that's going to be discount on bond pay. Whoop, what did I pick there? Discount on bond payable. And really, in effect, what happens then is that our interest expense increases by that amount of the amortized discount. So if you take 1,200, divide it by 10, because there's 10 times that we're going to make payments out for the bond, then every time we make a payment, the interest expense that we have to recognize is a little bit more than it would be otherwise, because we originally gave a discount and we didn't collect as much money as we would have, if we had gotten the full amount, essentially. So kind of, I don't know if this is helpful. This does make your brain stretch a little bit, as far as accounting concepts go. But in essence, what we're doing is we could have otherwise recorded some sort of expense here when we first took the discount and called it an expense. But instead of doing that, what we do is we capitalize this thing onto our financial statement, like we just looked at with the discount here, like this. And then we slowly get rid of that discount over each payment period. And in effect, we increase the interest expense, and we recognize this $1,200, hit to our financial position over each payment period. So I don't know. That's a little theoretical, if that hurts your brain, but just practice the mechanics of it. One thing, you need to know how many payments there are. and then you just divide. We're just doing straight line amortization of the bond payable. And then the discount is just, you need to know, 97 means 97% of the cash is received and 3% is the discount, basically. Okay, and then we're going to have the second payment, and it's going to be exactly the same as the first payment, but the formula didn't work. That's cool. Everything, moves down with the cells, so just fix that. And then once the bond is matured, so at the very last instance of us paying this thing back, the discount is now gone after we've paid each, we've recorded an amortization on each one of the periods. And then what we're doing is we're paying the cash back, right? So we borrowed this money. Oh, we don't want the credit, we want the debit version. We borrowed the money. Oh, sorry. We need our bond payable. There we go. We're crediting cash and debiting our bond payable for the 40,000. So we end up having to pay back a little extra than we actually borrowed, right? Bonds are really just a way to raise money, but since we had to do a discount, we ended up having to pay more back at the end than we borrowed in the beginning, and that's that discount that we were talking about, essentially. So, yeah, a little tricky, but with some practice, I think you'll at least be able to get the mechanics down pretty easily. Okay, so now we're on to this problem here, and I'm going to steal some of the information from here because most of it's applicable. So let's just delete that one out. So bonds payable then is 140,000. That's what we got there, and we issued that much of 4-year 7% at 104. So now our bonds are more. The 7% is better than what investors can get out in the market right now. So we have a bond premium, not a bond discount. Our bonds are better than what's out there right now. And so we get to get extra cash, basically. So that's a little bit better. And we're going to put that in a debit then. Did I do that right? I think that's supposed to be a credit. Yeah, sorry, that's supposed to be a credit. There we go. Because that's going to pump up our cash a little bit, right? The way that the accounting works is this being a debit reduces our cash a little bit, but when it's a credit, which we will just take this times 0.04, so it's 4%. 100% is just when it says, if it was just at 100, that would be the full amount. So if it's 104, it's 4% higher. And, excuse me, if it's 97, it's a 3% discount, right? So make sure you understand that. Then we just add those together. And so, yeah, like I said, we're able to get a little extra money because our bonds are more attractive as an investment opportunity for investors now because the rate on the 7% is higher than what investors might be able to get otherwise. Okay, so again, I'm going to just paste some of this in here, but we're going to need to change this. So now we're going to be amortizing the bond, the premium. And so we're going to be debiting that premium. It's a credit for when it's originally recorded, as you can see right here. And so the cash portion that we pay is always just the full bond payable amount times the interest rate. Oh, wait, did I do that right? I think that should work. I guess we're going to see. Okay. And then the interest expense is going to be a little bit lower, right? So we're going to be debiting. Okay. So first we need to see how many periods are there. So there's 4 years. There's 2 payments. So 4 times 2 is 8. So we're going to be dividing the 5,600 by 8. And then that is going to, so our premium is going to be going down a little bit. Oh, I'm sorry. That's what I messed up. Remember, don't be like me. Do the problem right. Divide by 2, right? We're doing 2 payments a year. So really it's 3.5% interest on each of the 2 payment periods. And then our interest expense is reduced a little bit. So that's how we recognize this on the income statement over the life of the bond, is that the interest expense we recognize is a little bit lower. So we could have recorded revenue, just like here with the discount, we could have recorded expense right at the initial bond issuance because of the fact that we had to do a discount or a premium in this instance. But instead of recording that as an expense or revenue kind of thing, we capitalize it. So we put it on the balance sheet, and then we cut it up into little pieces, right? The revenue or expense kind of related transaction, and we record a little bit of that through a reduction or increase in interest expense each period. So, and then again, it's the same, just over the life of the bond, you continuously make the same payments, and then we pay the bond off. So at the end of the life of the thing, we have to repay the money that we borrowed as a government or a business can issue bonds, and that's the 140. So we get to pay back less than we actually borrowed, right? We got 145,600, but we only have to pay back 140,000. So pretty cool. Okay, let's look at another problem. So now we're at 98, and I'm really going to steal the accounting now because this one's going to be real similar. So discounts on bonds and premiums on bonds, they have really similar accounting. So it's not too tricky once you get the pattern of what you're doing down. As far as the theory goes, good to learn it, but don't worry too much. As long as you can do the math, doing the math is first and foremost, right? So we issued $1,100 bond, so that comes out to $100,000. But the amount of cash that we got was only 98% of that, because we were issued at 98, as it says. So the difference between those two is 2,000. And then shoot, I bet I can even just steal this here. Paste that in, and then just update the factors. So it's twice a year still, so that still makes sense. It's 10% now instead of 8. So we're going to say take 10% divided by 2. And then the discount period it's 8 years, 2 payments each again, so it's 16. I'll just write it out for you guys. If you're 8 periods times 2 payments per year, and we're dividing the discount by that amount. And again, you'll see that increases our interest expense a little bit, which is what we'd expect to see as we incur the effect of the bond discount. And then at the end of the whole thing, we just have the 100,000 that has to be repaid. And there you go. Cool. Yeah, just practice those a few times. Get the logistics down. It's kind of like depreciation, in a way, sort of an idea. It's straight line amortization, though. And, yeah, try to understand the theory of it, but definitely, if you don't understand the theory, but you know how to do the mechanics of what's happening here, you know what accounts to pick, you can still get your points and, sharpen up your theoretical understanding later. Make sure you can do the problem right, first of all. Okay, here we have a payroll problem. Again, so we've got salaries expense. And what did we pay our employees? $40,000. So we had to pay them, we paid them $40,000. Sometimes these problems too is you might get a little tricked or it's hard to grasp conceptually because we're paying them $40,000, right? But the actual cash that we pay them is less than that. You know what I mean? And let's just do that. I'll show you. So federal income tax, right? We keep this money in our account at the business. So federal, state income tax. Let me put these all in, then I'll continue my explanation. Social Security, Medicare. Ooh, I could have copied in from that other place, but that's okay. Boop, boop, boop. There we go. Okay, so it tells us $8,000 in taxes, federal income tax, $4,000 state income tax, $2,480 Social Security, $580 Medicare, $1,200 medical insurance, and then so the sum of I'm going to do 40,000 minus the sum. Oh, I didn't. Why is that being weird? I don't know. I didn't like that for some reason. Try that again. Weird. Okay. So like I was saying, we're actually only sending checks out to the employees of $23,740, but so we actually paid them $40,000. So if that's confusing, one way to think about this is it's almost like we handed them checks for $40,000, and then they turned around and said, "Oh, thank you. By the way, here is all this money." The employee hands this 16,260 back to us and says, "Can you please file this so I'm paying my taxes and my medical insurance for me, please?" Right? So we're essentially doing that. We are paying them this full amount of $40,000, but then they're, in essence, what would happen, if it's not how this actually occurs, but instead of going through, that would be inefficient, right? It wouldn't make any sense to give your employees a bunch of money and then give them a bill for taxes that they need to pay from the government, be like, "Hey, by the way, or whatever, have them kind of figure it out." And then they just give you the money. So in order to make that more efficient, the government, requires that businesses just withhold that money, never give it to the employees in the first place, and then send it off to the government directly, kind of like a wage garnishment or something. The business becomes the government's tax collector, basically, through what we're doing here, essentially. So they are being paid $40,000, even though they only get $23,740 cash. This is just the employees' taxes and other things that need to be paid, because that's life. These employees have to pay taxes, and so we just never give it to them. Essentially, that's how the procedure process works. Okay. And then on top of having to be the government's tax collector, we also have to pay our own taxes. And you better do all this right, because the government won't appreciate if you do this wrong. That can be very not good. Okay, so we need to record payroll tax expense. So this is the business. This is the business's expense right here. This is all employee stuff. Here's the business's expense, again with taxes. So this is what we actually have to pay. So we have, again, a similar situation with, we're going to match. Actually, I'm just going to copy that here because that's bugging me. So we have to match Medicare and Social Security and Medicare. Then we, as the employer, have some extra taxes to pay that the employee does not have to pay. FUTA and SUTA, unemployment taxes, essentially. And how much are those? Let's see. Well, one thing that's easy to do, you can always just match the amounts for Social Security and Medicare, because those are half paid by the company, half paid by the employee. So both of us are going to pay the same amounts here. Then FUTA and SUTA, they just tell us 320 and 800. And finally, we can just do equals the sum, of all these. So we had to pay for the benefit, it's kind of a bum deal when you think about it. I mean, just how this works. If you're a business, you get the task of, doing all the accounting and withholding payroll taxes and making sure you're paying them to the right entity at the right time frame. The good thing about all this, as a business owner, this can be painful, but the good on the positive side, this is job security for us accountants, right? Because this is a lot of work to maintain. But the government, tasks you to collect the taxes from the employees, and then they also tell you have to pay some taxes just because you have employees too, so you have to pay extra, Social Security and all this unemployment taxes and stuff as well. So kind of a double whammy, but job security for us here in the accounting world, because we like spreadsheets and figuring stuff out. Okay, and then we're finally just giving our employees their money. So this is a real classic, just cash goes down, liabilities go down, and we're all done. We've done our payment to our employees. Later, well, I guess I shouldn't say we're done. We're going to have to make payments of all these amounts to the right government entity at the right time frame, and all that kind of stuff. Okay, so on to the next problem. This is number 10. So this one is a little further on the bond amortization stuff. And so let's take a look here. Okay, how much cash was received at issuance? So again, this one's kind of asking the same kind of questions that other problem was having us do, the other couple problems, but it's just asking us in a little bit of a different way. And so here we could just say how much cash was received. It would be $240,000, but times 1.04 because it's at 104, right? So if we're getting more money, it's above 100. That means it's a premium. And then what is the amount of the discount or the premium? So you can, whatever it is, we could even just say, here's an easy way to do it. I guess it's easy. Let's just take this, paste it in, and instead of 1.04, we'll just say 0.04. You could have maybe just used your logic to subtract 240,000 from that amount to get there. That's fine. And then the amount that's amortized each payment, we have to again look. So it's 2 payments a year, and it's not always 2 payments per year. Like this could vary. This is just, we see that a lot in these problems. Really, all you need to figure out is how many times is it paid each year, interest payments, and how many years is it, and you just multiply those together. And so 8, right? 4 years, twice a year in this instance. And then okay. So now we have to figure out what is the amount of each interest payment. Let's do the just interest payment on the bond. First of all, would be 240,000 times 0.07. Oh, sorry, divided by 2. So times 0.07 divided by 2, because there's 2 payments per year. So this is, it's still going to be the X, but the 8,400 would be like the normal interest on the bond. And then the discount of the premium would be the 9,600 divided by, oh, sorry. Yeah, we already did that, essentially. It would be we just add in. I got to think about whether we're adding or subtracting. So we're going to subtract the amount of the 1,200 to reduce our interest expense. Why did that not work? Make sure I've got my Let's see. Okay, I got to think about this. Is that going to be opposite way? No. Oh, what the heck? Why is that not working? So 1,200. All right, I got to do it off. It's hard when you have to do all this work in one cell. So let me put it off to the side here. Again, similarly to kind of what we were doing for our journal. I like to see it more in like a journal entry type format. But 240,000 times 0.07, it's twice a year, right? Yeah, twice a year. So we're going to divide that by 2, and straight line. What amount is amortized with each payment? So really that should reduce. Let me try and just maybe I do it with like this. Maybe it doesn't like linking to that cell for some reason. So again, divided by 8. No, it still doesn't like that. Okay. Let me do it off the side, like I said. So 240,000 issued, and we can kind of like, let's go back to this problem and just look at the premium here and think about this. So what we're saying as far as cash premium on bond payable, you can do like BP too if you want to abbreviate in this chapter, and then the actual bond payable. So like we just said, our bond payable then is 240,000. The premium is the 0.04, and then we're going to get total cash of 249,600. Right? That's what we already kind of figured out. So that would be comparable to like this problem here. And I mean, I could even just put this in if you guys want to see. It's going to give us, fits here when we imagine that we're just doing that other page. So 240,000, it's going to give us problems. This is going to be the 0.07 divided by 2. Oh wait, what did that do different? Oh, sorry. Let me make sure I did that right. So the premium then is going to be the amount, times the 104. So this is, again, we're going to get the X's because I'm just trying to put this in a journal entry format we can just kind of look at together. So this is the right answer from 10. So we get $249,000 of cash received, right? That would be that. Our premium is 9,600 that we can see here. And then we need to figure out the amount that we'd be amortizing every month then would be the 8,400. And then the 1,200 would reduce. No, maybe that's what it's asking us is, now what amount is each interest payment? Oh, maybe it's asking the cash amount. Is that what it's asking? Oh, that's goofy. Okay. Oh, sorry. So it's asking what the cash amount is, not what the interest expense results in. I think maybe we should clarify that a little bit. But this is what would happen, right? This is the journal entry that we would see, and so the cash then is just that outstanding amount times the interest rate divided by 2, because we've got 2 payment periods. And again, this relates to this problem, but 7%, 240,000. And then we're amortizing that premium again over 8 payment periods, because there's 4 years, 2 payments per year, and then we just take the difference. The interest expense would be 8,400, but since we're amortizing the premium, it brings it down to 7,200. Okay, and then we can kind of fill out a table that's real similar to, like, if you're doing accumulated depreciation, kind of an idea. So as far as the carrying value and the unamortized premium, then the carrying value becomes the amount, I believe, here, and then the unamortized premium is the 9,600. So the carrying amount of the bond is just that. That's the full amount of cash that was received, not the bond amount. And then as the bond premium goes down by 1,200 every time, it's going to go to 0 eventually. Maybe I can just do the formula here. Oh wait, let me do one more thing. So this minus, I'm going to do F4 to lock the cell, and we could just drag this down. So it goes to 0 over the 8 payment periods, 4 years, twice a year, you know what I mean. And really, here's a good way to do this. We could say 240,000 plus the current unamortized premium. And then if we drag that formula down, we can see how it just goes away and eventually gets down to just that normal. We've amortized the full premium then at the end of the life of the bond, essentially. Okay. So again, we took this is just the bond amount plus the premium. And then as the premium gets smaller every time we amortize a little chunk of it, 1/8 of it, then our carrying value decreases because the unamortized premium is decreasing, basically. So again, a little tricky, nothing too crazy in terms of math, but you got to sort of wrap your mind around some of the logistics here from a technical perspective. So, okay, well, hopefully that was helpful. Let's go on to the last problem here, 11, and finish this. All right, so now we're on to the last tab here, and we're just going to do some ratio analysis. Shouldn't be too difficult here on this one, but always good to know what the ratios are trying to communicate. So that's probably the most important thing to pull out of these, is just to have a familiarity. The calculations are relatively easy, and there's lots of tools. AI is good at solving these problems from a actual calculation perspective. But what we need to know is, what do these ratios actually mean, right? Okay, so first thing, gross profit, we can just do, it's the net sales minus cost of goods sold. Whoop, boy, I did something wrong there. Too many zeros. So then we've got 1,800 minus 1,350, 16 minus 1,280. Okay, so that's our actual gross profit. So let's see what else we need. Income before income tax, interest and taxes. So here we're going to say net income. Okay, so we got to actually, okay, we don't know. We just need to take our gross profit, right? Because that's net sales minus COGS. And then we're going to back out operating expenses now. So this minus our OPEX. Okay, and then net income further reduces. This is our income. At this point, we have to also then take out interest expense and tax expense. to get to the very bottom line. Okay, almost there. Okay, so now I'm just pulling all these numbers off the table, right? Interest expense, tax expense. Good to go. Okay, and then gross profit, the gross margin ratio is then gross profit divided by net sales. So 25%. In this one, it's divided, what is net sales? 1,800. Oh, same thing, 25%. And in this one, it's 1,600. Okay, went down a little bit that year. Okay. And then profit margin ratio is a little different in that, paste this in, we're going to analyze not gross profit divided by net sales, but net income. And so it's a little different with our numerator. And let me just update these, 1,600. Okay. So again, this one's taking gross profit divided by net sales, and then this one's taking not gross profit divided by net sales, but net income divided by sales. Okay, and let's see. So yeah, and basically what we're saying is out of what these two ratios then sort of speak to is, from a gross margin perspective, how much is our cost of goods sold eating up of our profit margin, right? And so that really is a metric that speaks to how expensive our purchasing is, right? And then the net income metric is more speaks to how much of our sales revenue is not just cost of goods sold, but also how much is operating expenses taking up, interest expense, tax, all that stuff. So just they're different metrics essentially. And then as far as times interest earned, we want that interest, or the earnings before interest and taxes, EBIT. You'll see it EBIT sometimes. Excuse me. And we're going to divide that by the interest expense, which was 100. So 3 times the interest earned there. Again, just use the formulas here, and then divide by 105.25, so the interest. So we're dividing. And essentially what this one is saying is how, in regard to our interest expense, if we back out, before we consider the interest expense or the taxes, how many times larger is our net income before those interest and tax expense? How much can we cover of the interest expense? So it's kind of a metric that we could use to analyze the company's ability to meet the interest, obligations essentially. Are they making enough money to cover the interest expense? You could think of a scenario where they don't make enough money to cover the interest, and that's when, if you're a lender to this company, you're going to start being scared, right? And if you're running the company, you're trying to run it well, you should also be scared as well if you can't cover your interest payments. That's not good. It's not good for a business. It's also not good for you personally if you have some loan that you can't cover, and if you don't pull in enough profit, revenue from a job or something, and you have a credit card bill with interest, or you have a car loan or mortgage or whatever, you could run into some issues. Okay, and then the debt to equity ratio here, we're basically just, let me do the equal sign. We're taking our total liabilities divided by our equity, and here we got to calculate equity. So remember, it's assets minus liabilities. And so 200%, I'm going to update these, but so our total liabilities, it was 1,000 in this one as well. We had 1,400 in assets this time. And then here, and again, what we're saying is total liabilities, so 200 here in this year, that divided by equity. It doesn't tell us equity, but we can figure equity out because we know the accounting formula, which is assets equal liabilities plus equity, or in other words, assets minus liabilities equal equity. So assets minus liabilities. And what we want to see here is that a higher number is preferred, because that would, indicate that we've got more savings, if you want to think of it that way, more equity in the business than the higher your equity in the business versus the amount of debt that you have. That is a good, healthy sign, right? If you have way more debt than you do equity, maybe that's just the way it goes. I mean, that's kind of how, as long as you're able to make your debt payments, it's not the end of the world. That's life, right? And when you take out a mortgage for your first time home buyer and you don't have any equity built up, maybe you're younger and you're still saving money and you're new to your career and all that, your debt to equity ratio might be really high because you just took a new loan out to buy a house and you haven't had the time to save and all that kind of stuff and build up that equity through making payments against the loans. But in general, you would prefer, as you get more financially solvent, to generally, this is a generalization, but you'd want to move towards having more equity and less debt overall, or at least a better debt to equity ratio. Some really big companies still might have a ton of debt, but they might have a lot of equity built up as well. And so that ratio might still be decreasing, even though the fact they're actually taking more debt, using debt more as a tool to finance their operations. Okay, so getting a little bit theoretical here, but let's knock this thing out. So is your company's gross margin better? Yeah, that looks pretty good. So a high gross margin is good. Gross margin, again, means you've got your revenue is comparing your revenue to, or your net sales revenue to the cost of goods sold for that. Is your company's profit margin better than the industry average of 8%? No. So again, our purchasing and the cost we're buying our goods, and the price we're charging, that ratio is good. But then when it looks like the ratio of our net income is not great. So that means that we're incurring more operating expenses and more interest expense, for example, and potentially more tax expense than other businesses in our similar industry, as far as this average goes. Okay, is your company's times interest earned ratio better than the average of 8? No, right? So that's kind of what we're saying. And so taking this into account, it starts to paint a picture that our interest expense is quite high here, because our that's representative of us having a low times interest earned number compared to others benchmarked in our industry. Would say that we're paying more interest than others in our industry, basically. And finally, does your company's debt to equity ratio, is it riskier than the industry average of 1.2? And and I can't change the format, but if we put it into decimals, it would be 2.5, 0.5. So yes would be the answer there. So that all kind of paints a picture that this company has more debt than average and is paying more interest than average. But again, not that that's a death sentence. It just means that you're carrying more risk, right? Just like if you were you're going out and buy a new car, and instead of buying a used 2005 Honda Civic, you buy a brand new Ford Raptor truck or something that's $100,000, right? Maybe that's fine. It depends on your risk tolerance and your ability to make money and all those kind of things, right? And so that's kind of what we're getting at here, is just a risk management type of assessment. And if you're a lender, this becomes very important, these ratios, because you want to assess the financial solvency of your borrowers, because you don't want to lend money to businesses or people who won't be able to pay you back, right? So that these are the kind of ratios and calculations that a banker, a lender would kind of do to assess the repayment capacity of a borrower before they're give them some big business loan or something like that. So Okay, cool. All right. Well, that went a little longer than I was expecting, but hopefully you found that discussion helpful and it made sense and you learned a few things along the way. So thanks, everybody. I hope this was a helpful video overall, and I will see you in the next one or see you in class. All right. Take care.